Welcome back to Investing Talk Podcast.
Today we're looking at Intensity Therapeutics.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We are dissecting a fascinating, and I have to say, a very high-stakes story today.
It really is.
When you look at Intensity Therapeutics, you're looking at the quintessential clinical stage biotech firm.
A pure play.
A total pure play. Their entire future, everything, is riding on one single oncology drug candidate, INT230-6.
Which means right now, they have no products on the market.
Exactly. Zero commercialized products.
And that one fact right there, that tells you almost everything you need to know about the risk profile.
It does.
Because if you're 100% focused on research and development, and we're talking about expensive R&D,
Then you have zero product revenues. It's the classic high-risk, high-reward bet in this sector. The financials really just scream that.
yeah, they really do.
I mean, you look at a net loss of, what was it, $16.3 million for fiscal year 2024?
And it didn't stop there.
No, not at all. Then another $8.6 million net loss for just the first 9 months of 2025. They are burning cash.
But they have to, right? That's the cost of running these huge global clinical trials.
It is. Which brings us to the most important question. The cash runway.
Okay, so where did they stand?
As of September 2025, they were sitting on about $7.2 million in cash.
Which isn't a lot, given that burn rate.
Not at all. But then they did a capital raise, a $4.0 million direct offering, which closed in early November at 80 cents a share.
And that $4 million was, absolutely critical.
It was life support. It buys them time. It extends their liquidity, maybe into 2026. But let's be super clear.
Yeah.
$4 million is a drop in the bucket compared to what you need to fund a 333-patient global phase 3 trial.
Right. It's a bridge, not the destination.
It's a bridge. And while they're on that bridge, they get a little bit of good news, procedurally anyway.
The Nasdaq compliance issue.
Exactly. The stock's been trading below the minimum bid price, which is common for companies this size. But in early December, they got a critical 180-day extension.
And that's bigger than it sounds, isn't it?
Oh, it's huge. It gives them breathing room until June 2026. It takes the immediate threat of delisting off the table.
Which is something that just terrifies institutional investors.
It lets the market focus on the science, not the technical share price.
Perfect transition, because if the science isn't there, none of this other stuff matters. We've laid out the financial risk. Now, let's get to the bull case, the technology itself.
Okay, so this all comes down to their proprietary platform. It's called Diffuser X.
And this isn't your typical IV chemo drip.
Not even close. It's a novel. They call it an amphiphilic chemistry. But what that really means is it's designed for direct intratumoral delivery.
Okay, let's break that down. Amphiphilic chemistry.
Right.
What's the simple version? And why is injecting it straight into the tumor such a big deal?
The simple version is, think of traditional chemo like flooding an entire field just to water one tiny plant.
Everything gets soaked, the good cells and the bad.
And you get horrible side effects.
Yeah.
Amphiphilic chemistry means the drug is sort of sticky. It likes both water and fat, so it binds tightly inside the dense tissue of the tumor itself.
So the drug stays where you put it. That's the key.
That is the entire key. The pharmacokinetic data is just incredible. It shows over 95% of the active agents.
And these are heavy-duty agents, cisplatin, vinblastine.
Right, potent stuff. Over 95% of it stays localized in the injected tumors. And that translates directly to a much, much better safety profile.
Less collateral damage.
Far less. You see minimal grade 3 systemic adverse events because the rest of the body just isn't getting hit with that toxic payload. It's a huge deal for patients.
It's a surgical strike versus a carpet bomb, and the regulators seem to like it.
They do. They have an orphan drug designation for sarcoma. That's a big one. It means 7 years of market exclusivity if they get approved.
And there was the fast track for breast cancer, too.
Right, for metastatic breast cancer. And both of those things, they're signals from the FDA. They're saying, we see a high unmet need here, and this looks promising. It can shave years off development.
Which for a small company is priceless.
It's everything.
Okay, so this is where it gets really exciting for me, the actual data. The validation. This wasn't just a press release. It was published in a major journal.
A Lancet journal, eBiomedicine, in October 2025. And that peer-reviewed paper was the catalyst. It's why the stock went wild.
Because the efficacy numbers were just kind of staggering for these patients.
They really were. A 75% disease control rate.
Right.
And this is in heavily pretreated patients who failed other therapies.
And it worked across a whole range of cancers, too.
More than 20 different types. That suggests the mechanism is, fundamental. It's not just for one specific kind of tumor.
But the survival numbers are what you really have to focus on. We need to pause on this.
Oh, yeah.
The patients in this trial, they've run out of options. Historically, their median overall survival, their MOS, is maybe 4 to 7 months.
A grim prognosis.
And in this trial, they got an 11.9-month median overall survival. That's double the historical average.
And it gets even better.
Oh.
The sarcoma subset, which is the focus for their big phase 3 trial, the median overall survival there jumped to 21.3 months.
21 months. For patients who are expecting 4 to 7, you start to see why the market got so excited.
It's a massive, massive difference.
But there's another piece to this, the aha moment for the science nerds, which is this abscopal effect. For anyone listening who isn't an immunologist, what is that?
So the abscopal effect, it basically means the local injection triggers a systemic immune response, a body-wide response.
How does that work?
You inject the drug into one tumor, let's say in the liver. The drug kills those cancer cells, but as they die, they release these tumor antigens. And that process essentially trains the body's own immune system, the T cells, to recognize that cancer as an enemy.
So the injected tumor becomes a personalized vaccine factory.
That is a perfect way to put it. It turns the tumor into an immune training camp. And then those newly trained T cells go hunting all over the body.
And they attack tumors that you didn't even inject.
Exactly. They saw shrinkage of distant tumors, in the lung or bone. And it happened in about 20% of cases in the trial, which is a very encouraging rate. It means this isn't just a local chemo, it's kicking off a systemic immune attack.
A dual mechanism. And that's what the market was waiting for, that peer-reviewed validation.
And when it hit on October 30th, it was like a seismic event.
The stock surged, between 160 and 208% in one day.
On just insane volume. 1.43 billion shares traded. For a tiny company like this, that is unheard of. It was the market screaming, "We see the value in this science."
And the analysts followed right behind.
Oh, absolutely. The sentiment shifted almost overnight. The consensus now is a strong buy. We're seeing 12-month price targets from $2.98 up to $4.50.
Okay, let's ground that for a second. That's suggesting something like 550 to 900% upside from where it's been trading.
It does.
Which shows how much value they see in a successful phase 3. But it also highlights the insane volatility and risk here, doesn't it?
It does. Those targets assume everything goes right from here on out. And to get there, they have to deal with those mechanics we talked about.
Back to the Nasdaq problem.
Right. They've approved a reverse stock split. The ratio could be anywhere from 1-for-5 to 1-for-30.
Now, reverse splits make a lot of retail investors nervous. They see it as a sign of distress.
And sometimes it is. But here, the goal is purely technical. It's about getting that share price back over the minimum bid price to stay on the Nasdaq.
Why is that so important when the science is this good?
Institutional money. It's that simple. Big funds, pension funds, ETFs, many of them have rules that say they can't own penny stocks.
Stocks under $1 or $5 in some cases.
Right. So if they can get the price up and keep it there, it opens the door to a much, much larger pool of potential investors. And that's the fuel you need for a phase 3 trial.
Okay, so we've got great data, analyst optimism, a plan for the technicals. But we have to talk about the bear case. The risks they're very real.
They're significant. And they all come back to that first thing we talked about.
Funding.
It's all about execution and funding. They're huge, global, phase 3 sarcoma trial, Invincible 3. It's the key to everything. But they had to pause it.
They paused it back in March 2025.
Due to funding constraints. That pause is the big, dark cloud hanging over this whole story.
Because a global trial like that is just a money-eating machine.
An enormously expensive machine.
Yep.
That recent $4 million raise helps, but to restart and then get enrollment back up to speed for Invincible 3, you need a sustained multi-million-dollar commitment.
So that's a big question mark. Can they get the financing, whether it's through another offering or a partnership, to get that trial fully back on track?
That is the one question that matters most right now. But if they can solve it, we do have a very clear timeline of catalysts coming up.
Over the next, say, 12 to 18 months.
Exactly. First, in Q1 2026, we expect to see that reverse stock split happen. That helps with credibility.
And access to institutional money.
Then, probably Q1 or Q2 of 2026, we're all watching for the big announcement, the restart of the Invincible 3 sarcoma trial. That's the signal that they've secured the funding.
And we can't forget about breast cancer.
No, that's a key one. Sometime in 2026, we expect to see data from the Phase 23 metastatic breast cancer trial, Invincible 4.
And that one has a faster readout, so it's an earlier shot on goal.
A critical checkpoint. It could provide more validation even before the big sarcoma results come in. And then the main event.
The interim analysis from the Phase 3 sarcoma trial?
Sometime in 2026 or 2027. That's the moment of truth. That data will either de-risk this whole thing dramatically, or it'll be a major setback.
So let's tie this all together. For someone listening, what's the takeaway here?
The investment thesis is really one of asymmetric risk and reward. It is a high conviction, very high volatility play.
The market cap right now is only around $21.7 million. I mean, that is tiny.
It's tiny compared to the potential market.
Mm.
And it is a big if INT 236 gets approved, you're talking about potential multi-billion-dollar peak sales.
So this is not a short-term trade. You need an 18 to 36-month time horizon and a stomach for the volatility.
Absolutely.
Mm.
Especially with the funding questions still out there. But the setup is interesting.
How so?
You had the massive spike on the peer-reviewed data. The science is validated. Now the stock is pulled back, is consolidated because of profit-taking and those funding questions.
So for someone who believes in the science,
It's a classic contrarian setup. You can accumulate shares based on fundamentals that have not changed, while the market is focused on the near-term financing risk.
here's a final thought I want to leave with you, something to mull over.
Go for it.
Intensity has already worked with the makers of Keytruda and Yervoy in earlier trials. They've shown their drug can be combined with the biggest cancer drugs in the world. So now that they have this incredibly compelling, peer-reviewed clinical data out in the world, what's to stop a major oncology player from just stepping in? What kind of partnership or maybe even an acquisition could materialize that would just eliminate that funding risk overnight?
It's a very real possibility. Definitely a space to watch.
Make sure you subscribe so you don't miss our next analysis.